May 6, 2010. A day that started like any other on Wall Street would soon turn into a nightmare scenario. The unthinkable was about to happen. The United States stock market was on the verge of collapse due to a mysterious event that would later be known as the flash crash of 2010, when algorithms almost destroyed Wall Street. As midday approached on May 6, 2010, something strange started to unfold in the high-frequency trading world. These algorithms, designed to make trades at lightning speeds, had begun to behave erratically. The firm Waddell & Reed in Kansas City, Missouri unleashed a sell order for E-mini S&P 500 futures contracts worth $4.1 billion, an attempt to limit their exposure to the market. However, due to the sheer size of the order and the speed at which HFT algorithms operate, the market couldn't absorb it fast enough. This deluge of sell orders triggered a chain reaction as HFTs, designed to detect and react to rapid price movements, started selling off assets automatically, fueling further panic. As a result, the Dow Jones Industrial Average plummeted approximately 600 points in just a few minutes, a staggering drop. The culprit? High-frequency trading algorithms preying on each other's vulnerabilities and misinterpreting market signals. The vicious cycle led to an unprecedented flash crash, wiping out nearly $1 trillion in market value in mere minutes. Navinder Sarao, a British day trader, was later indicted for his role in exacerbating the crisis. Operating from his modest suburban home, Sarao exploited the glitch-prone nature of HFT algorithms using a technique called spoofing, flooding the market with fake orders to manipulate prices and then capitalizing on the ensuing chaos. However, pinning down the entirety of the blame on Sarao would be misguided. The flash crash served as a sobering reminder of the fragility and unpredictability inherent in today's hyper-connected financial markets. HFT algorithms, initially hailed for their ability to enhance market liquidity, had proven to be a double-edged sword, demonstrating both breathtaking efficiency and disconcerting volatility. The flash crash of 2010 marked a turning point in the public's perception of HFT algorithms. No longer regarded as infallible tools for wealth creation, they were now seen as potential threats to market stability. An uncomfortable truth that still reverberates through financial institutions and regulatory bodies today. In the aftermath of the flash crash, investigators scrambled to identify a cause amidst the chaos. One theory that emerged was the fat finger hypothesis, an erroneous trade causing a domino effect. The Securities and Exchange Commission and Commodity Futures Trading Commission joint report on the incident refuted this notion. The report revealed that during the peak of the crash, trades for Procter & Gamble stocks fluctuated between 32 and 100,000 per share within minutes. A single trader with the fat fingers could not have caused such extreme volatility. Moreover, the scale of trading involved pointed towards algorithmic high-frequency traders rather than human error. On that day, approximately 21,000 trades were executed in just 14 seconds, totaling around 4 billion shares and valued at over 200 billion. This level of activity was far beyond what any individual trader could manage manually. Another piece of evidence debunking the fat finger theory came from the timing of the crash. It occurred during the lunch hour when most human traders are away from their desks, leaving the market primarily controlled by algorithms. The rapid recovery also suggests an automated response rather than a slow human correction process. The scale, speed, and pattern of trading all pointed towards HFTs as the primary culprits behind the flash crash. However, it's important to note that they didn't intentionally cause the crash. Instead, their algorithms reacted to market conditions in ways their creators hadn't anticipated, highlighting a critical flaw in our over-reliance on automation and finance. This revelation sent shockwaves through Wall Street and regulatory bodies worldwide. If not for the fat finger theory, we might have addressed these issues sooner, making the financial system less vulnerable to similar incidents in the future. Yet here we are, still grappling with the consequences of our reliance on unregulated high-frequency trading algorithms. The flash crash served as a wake-up call, reminding us that even in the world of high finance, things aren't always what they seem. Sometimes, the smallest mistake can trigger catastrophic consequences, and sometimes, the culprit isn't who we think it is. 2010. A year that would etch itself into the annals of financial history as one marked by chaos and uncertainty. On May 6th, the world witnessed an event that came to be known as the flash crash. Within the span of just a few minutes, trillions of dollars were wiped off the value of major companies, only to rebound moments later, leaving investors and regulators stunned. At the heart of this crisis were high-frequency trading algorithms, computer programs designed to execute trades at lightning speeds. Unbeknownst to many, these silent players had been steadily gaining influence in the world's financial markets. They could analyze vast amounts of data far quicker than any human ever could, placing orders in microseconds and exploiting market inefficiencies with surgical precision. Yet, despite their growing importance, HFT algorithms remained largely unregulated. This lack of oversight was partly due to the opaque nature of these systems. Many market participants didn't fully understand how they worked or who controlled them. Moreover, regulators struggled to keep pace with technological advancements, often finding themselves playing catch-up in a game where rules changed faster than they could write them. The Securities and Exchange Commission, the primary regulator of U.S. financial markets, had been aware of potential risks associated with HFTs since at least 2004. However, it wasn't until after the flash crash that they began taking serious steps towards implementing safeguards. By then, the damage had already been done. One such example is the limit up limit down rule, introduced in 2012, which aimed to prevent trades from occurring outside predefined price bands. While this measure undoubtedly added a layer of protection, it did little to address the core issue, the lack of transparency and accountability surrounding HFT algorithms. In retrospect, the flash crash served as a stark reminder of how regulatory oversight can lag behind market realities. It exposed the vulnerabilities inherent in our over-reliance on complex systems we barely comprehend, raising critical questions about trust, control, and responsibility. Join us as we delve deeper into this digital labyrinth, uncovering the intricate web of relationships between humans, machines, and money. Our journey is just beginning. In the wake of the flash crash, a whirlwind of activity swept through the financial regulatory landscape. The Securities and Exchange Commission and Commodity Futures Trading Commission joined forces to investigate the causes behind the market freefall, pouring over terabytes of trade data in their quest for answers. Their joint report, released in September 2010, revealed a complex ecosystem of human and machine actors interacting in unforeseen ways. High-frequency trading firms, like those using algorithms developed by Citadel Securities and Knight Capital, were fingered as key contributors to the crash. The report also noted the role of market structure issues, such as the fragmentation of trade across multiple venues and the lack of real-time risk controls. Regulatory responses followed swiftly. In 2010, the Dodd-Frank Wall Street Reform and Consumer Protection Act was signed into law, ushering in a new era of financial regulation. Among its many provisions, the act granted expanded authority to the SEC and CFTC for overseeing the swaps market, established a new regulatory framework for over-the-counter derivatives, and created the Consumer Financial Protection Bureau to safeguard consumers from predatory lending practices. The flash crash served as a catalyst for a renewed focus on market structure reforms. In 2012, the SEC adopted Rule 6110 of Regulation NMS, which mandated the removal of certain protected quotes from trading venues if they were more than half a second old. This action aimed to reduce the potential for disorderly markets caused by stale, inaccurate price quotes. In addition, the SEC implemented circuit breakers, or limit up, limit down mechanisms, designed to halt trading when prices moved too rapidly. These measures sought to prevent another flash crash by introducing a safeguard that could temporarily pause markets and allow for human intervention during extreme volatility. However, not all regulatory efforts have been successful. The stop rule proposed by the idle stop rule proposed by the SEC aimed to address concerns about the risks posed by idle high-frequency trading algorithms. The rule would have required firms to either monitor their algorithms continuously or disable them during periods of inactivity. Despite widespread support from industry experts and market participants, the proposal was ultimately abandoned due to opposition from high-frequency trading firms and other Wall Street interests. The aftermath of the flash crash serves as a stark reminder of the delicate balance between technological innovation and regulatory oversight in our financial markets. The events of May 6, 2010 exposed the vulnerabilities lurking within the shadowy corners of our high-speed, interconnected world. As we continue to navigate this digital labyrinth, it is crucial that we remain vigilant, asking tough questions and demanding clear answers about the true costs and benefits of our ever-evolving financial systems. As we delve deeper into the mysterious flash crash of 2010, let's take a closer look at some of the specific stocks that were caught in the crossfire. On that fateful day, Accenture, a multinational professional services company, experienced an almost unfathomable plunge from 40.75 to just 1 cent in a matter of minutes. This free fall was so astonishing that it even triggered an automatic halt in trading, which is designed to prevent such catastrophic drops. Another unfortunate victim of the flash crash was the seemingly unflappable Procter & Gamble, a 180-year-old consumer goods titan. Trading for this blue-chip stock nosedived from 62.19 to a mere 10 cents, leaving investors and regulators utterly bewildered. In fact, during the flash crash, over 20,000 trades were executed at prices that were clearly outliers, deviating significantly from their corresponding stocks' average prices. But what could have possibly caused this chaos? To answer that question, we must first understand the role of high-frequency trading algorithms in our financial markets. HFTs are computer programs designed to execute trades at lightning speeds, often exploiting even the most fleeting market inefficiencies. On May 6, 2010, a perfect storm of market conditions and technical glitches allowed these algorithms to spin out of control, generating a destructive feedback loop that eventually led to the flash crash. One such HFT firm was Waddell & Reed, a Kansas-based asset management company. In an attempt to protect their positions from adverse price movements, they unleashed a massive sell order for $4.1 billion worth of E-mini S&P 500 futures contracts, the equivalent of roughly 7% of the entire day's trading volume. This deluge of selling pressure proved to be the spark that ignited the flash crash. As we've seen, the flash crash of 2010 was a stark reminder of the vulnerabilities hidden within our complex financial systems. The case studies of Accenture and Procter & Gamble serve as chilling examples of how even the most seemingly stable companies can become pawns in a high-stakes game of digital chess. While HFTs and algorithms have undoubtedly brought numerous benefits to our markets, their potential for destruction cannot be ignored, nor can the need for stringent regulation and oversight. 2010, a year that would etch itself into the annals of financial history. Amidst economic recovery from the Great Recession, an event occurred that sent shivers down the spines of market participants worldwide. On May 6, 2010, the Dow Jones Industrial Average plummeted nearly 1,000 points in a matter of minutes, only to rebound almost as quickly. This brief yet catastrophic event became known as the flash crash. To understand its implications, let's turn to Dr. Andrew Lo, a renowned financial expert and the director of the Laboratory for Financial Engineering at MIT. According to Dr. Lo, the flash crash was a wake-up call for regulators, market participants, and the general public about the vulnerabilities inherent in our complex financial systems. At the heart of the issue were high-frequency traders, algorithms designed to execute trades at lightning speeds. During the flash crash, these algorithms exacerbated existing market tensions, leading to wild price swings and billions of dollars in losses. Dr. Lo explains, in this hyper-connected environment, small errors can have outsized consequences. So what lessons did we learn from the flash crash? Regulators took action by implementing safeguards aimed at mitigating future risks. Circuit breakers were introduced, halting trading when prices moved too rapidly. Additionally, rules were put in place to ensure that market orders were executed at fair prices. But have these measures been enough? According to Dr. Lo, while we've made progress, there is still work to be done. He emphasizes the need for transparency and ongoing vigilance, stating, "Financial markets are constantly evolving, and so must our regulatory frameworks. As we tread forward into an ever more automated financial landscape, let us remember the lessons of 2010. For in the world of high-frequency algorithms, complacency can be a costly mistake." 2010's flash crash served as a wake-up call, exposing the vulnerability of financial markets to high-frequency algorithmic risks. But have we truly learned from this event? In the aftermath of the flash crash, regulatory bodies like the Securities and Exchange Commission and Commodity Futures Trading Commission took action. They implemented measures aimed at curbing excessive volatility and improving market resilience. Among these were circuit breakers, which halt trading when prices fluctuate too rapidly or dramatically. However, despite these improvements, the fundamental risk remains. Our financial landscape is increasingly dominated by complex algorithms whose decision-making processes remain largely opaque to human overseers. Even regulators admit they're playing catch-up in understanding these systems. Moreover, while circuit breakers can halt trading during extreme events, they don't address the root cause, algorithmic behavior that contributes to or even causes such crises. As Dr. Larry Harris, a finance professor at USC and former SEC chief economist, puts it, circuit breakers give us time to catch our breath, but they don't solve the problem. The ongoing challenge lies in creating regulatory frameworks that keep pace with technological advancements without stifling innovation. This is no easy task. Regulations must strike a delicate balance between safeguarding market integrity and fostering an environment conducive to healthy competition. Consider the case of Knight Capital Group, a major player in high-frequency trading. In 2012, a software glitch caused the firm to lose $440 million in just 45 minutes, nearly leading to its collapse. This incident underscores the reality that technological failures can still wreak havoc even after the lessons of the flash crash. In conclusion, the flash crash of 2010 was a pivotal moment revealing the dangers posed by high-frequency algorithms. Progress has been made, but as technology continues to evolve, so too must our regulatory responses. Complacency is not an option when the stakes are this high. After all, in the world of finance, it's often said that those who forget history are doomed to repeat it. Let us ensure we remember the lessons of 2010, lest we find ourselves once again staring into the abyss of another flash crash.